Assalamualaikum. Today we group 5. We're going to present to you about the effect of OPR reduction towards borrowers, savers and the economy. Alright, so before we start, this is all my group members. We have 5 of us inside this group. What is an OPR? It's the overnight policy rate where the benchmark interest rate set by Bank Negara Malaysia. It's used for overnight borrowings lending between commercial banks like Maybank, SMB Bank and others. The rate is to control inflation and support economic growth. We have one more, almost similar as OPR, which is exponential monetary policy. It's the policy to increase the money supply and stimulate economic growth. BNM applied this by lowering their interest rate, reducing reserve requirement and buying government securities. This will lead to more for borrowing, consumer spending, investment and also job creation. Alright, what is base rate or well known as standardized base rate? Because it was replaced in August 2022. It's a base interest rate used for floating rate loans and financing while linked to OPR. Banks add their own spread to determine final loan interest rate. SBR is only a base rate, it's not the actual rate the borrowers are paying. Alright, so next is cost of borrowing. What is cost of borrowing? It's the money that we obtain from loan and financing, which come with interest payment, financing fees, and also related fees. It helps business to compare financial options to see if it's worth it to be invest. A lower borrowing cost is cheaper to finance investment. Alright, last but not least, what is monetary policy transmission mechanism? It's a process through which changes in the OPR influence the economy by affecting interest rate, spending, investment, inflation, economic growth. Also, it occurs in interest rate, credit, and asset price channel. Alright, based on the article assigned, we studied the OPR car offers relief to borrowers, both for consumption, which is BNM reduced the OPR from 3% to 2.75% in over 2 years, which made the installment lower and cheaper, and also making households have higher purchasing power since they have more cash in hand. So, with the reduction of OPR, commercial bank as well reduce their rate as well, which is SBR standardized base rate, BR is base rate, and base lending rate. So let's get into what's the main reason for implementing an exponential monetary policy. It's because of to combat back the slowdown of global trade and avoid any possible reason that affect the economic growth, because we want our economy to always grow much better, and then to increase household consumption because it's the main factor of economic growth. And then last but not least, this acts as a financial buffer for household.
The overnight policy rates or OPR directly dictates commercial banking rates. When Bank Negara lowers the OPR, it cuts funding costs for banks, leading to cheaper variable rate loans. For everyday consumer, this means direct saving. For instance, keeping an extra 70 to 75 ringgit a month on a 500,000 home loans. However, it also means a lower returns on fixed deposits. When the OPR goes up, the exact opposite happens. Borrowing costs, monthly installment, and deposit rates all rise together. When the OPR shifts, different loan products react in completely different ways. Housing loans take an immediate hit, resulting in either a jump in your monthly installment or a longer loan tenure. For businesses, variable rate SME loans face increased costs and lower cash flows, while fixed rate term loans stay safe and stay unaffected. Conventional personal financing and floating rate Islamic facilities will adjust alongside OPR trends. The major exception here is credit cards. Their standard retail rates remain completely fixed between 15% and 18% per annum. Reducing borrowing costs serves as a major catalyst for economic activity. For households, cheaper credits motivates people to finance big-ticket items like cars and homes instead of putting money aside to save it. This growth also leaves a sad price in real estate and stocks, making consumers feel wealthier and boosting their daily spendings. On the commercial side, lower interest rates allow businesses to comfortably fund major capital investment. Projects that were once written off as too expensive suddenly cleared the financial hurdle and became profitable to pursue.
Okay, let's talk about effects on aggregate demand, real GDP, employment, and inflation. When Bank Negara Malaysia reduced the OPR, it grew the aggregate demand from 5.1% in 2024 to 5.2% in 2025. Household spending remained firm, supported by positive labor market conditions and more targeted policy measures. Simultaneously, it boosts the gross domestic product, which is GDP, because the OPR made the loans cheaper. Consumers will purchase more products and businesses build more factories and need to increase more production at a time. Then, there will be many opportunities for the unemployed to be employed to produce a product. However, the increasing demand and expeditious economic growth will lead to an increase in price level of the product, which means inflation. Individuals, households, and industries that get benefits from reduction of OPR. So there are the parties that get benefits from reduction of OPR. First, individuals and households will get cheaper variable rate loans as banks lower the standardized base rate, which is SBR. For industries, property developers get more buyers, and this could be good news for property stocks. Lastly, automotive and manufacturing sectors benefit substantially from cheaper credit, lowers their corporate financing costs, and makes the business expansion more affordable. So why does fixed rate borrowers may not receive the same benefits as variable rate borrowers? Firstly, variable rate borrowers experience instant financial relief while fixed rate will remain constant. Secondly, the impact of variable rate borrowers directly by Bank Negara Malaysia's OPR decisions, while the fixed rate is unaffected by changes in the OPR. Last point for this topic is disadvantages for savers, retirees, and households dependent on deposit income. Low OPR generates significant financial disadvantages for savers, retirees, and households on deposit income. It heavily influences the interest rate banks offer on fixed deposit and saving accounts. The first one is retirees and households rely entirely on fixed deposits yields from day-to-day living expenses to see their monthly passive income. Other than that, savers and retirees need to bear the brunt of increasing prices of essential purchases like food, healthcare, and utilities that were having an inflation that has been contained in the country.
Next is, was reducing OPR the most appropriate policy? For the first point is inflation rate. If the inflation is low or under control, lowering the OPR can help increase spending and investment without causing prices to rise too much. And for the second point is economic growth. When economic growth is low, reducing the OPR can help support the growth because lower interest rate makes loan more affordable, and it allows business and consumer to make more loan as the loan repayment becomes lower. For the third point is household debt. Lowering the OPR can reduce the debt burden for existing borrower as monthly loan repayment decrease. However, it will also encourage for household to borrow more because the cheaper loan. And the last point is the consumer and business confidence, which is reducing the OPR can improve confidence among consumer and businesses because commercial bank reduce their lending interest rate.
Next is the key complementary measures utilized by Bank Negara Malaysia to ensure financial stability. So first, regarding the implementation of macroprudential regulations, which is lowering mortgage rates, risk a financial crisis by causing asset price inflation, especially among speculators and also wealthy investors. So in order to protect the financial system and to keep housing affordable, BNM utilizes key macroprudential tools. These include the debt service ratio to cap debt commitments against actual income and the loan to value LTV ratio to limit approved loans relative to total property value. And second, we look at the enforcement of responsible lending requirements. So cutting the OPR reduces interest rates, making consumer loans cheaper. However, overborrowing risks high household debt and bankruptcies when rates rise again. So in order to prevent this, BNM enforces strict regulatory lending requirements. Banks must assess applications using net disposable income NDI instead of gross income. So this ensures borrowers can still repay their debts and keeping non-performing loans NPL low, and also keeping banks stable. And next, we look at the targeted interventions for businesses and also vulnerable households. So during downturns, cautious commercial banks favor giant corporations over SMEs because they are prone to bankruptcy. So to address this, the government provides specialized funds and schemes like the Credit Guarantee Corporation (CGC). So by absorbing the financial risk, these guarantees confidently enable banks to approve loans, helping SMEs sustain business operations, generate critical job opportunities, and reduce unemployment rates. And lastly, we address targeted fiscal support for vulnerable households. So, monetary policy changes suffer from a 6 to 18-month outside time lag. So, this leave the B40 group temporarily unassisted despite the OPR cuts. So, in order to prevent this, monetary policy must be paired with fiscal policies, which is direct cash transfers such as Sumbangan Tunai Ramah (STR) and also essential subsidies. So this target high MPC, low income households driving immediate spending on basic necessities to boost aggregate demand and also to support GDP growth. Moving on to financial literacy programs. So lowering the OPR cheapens credit but risks reckless borrowing, impulsive credit card spending, and also property over leveraging due to poor financial knowledge. So to boost literacy, the Financial Education Network, co-chaired by BNM and the Securities Commission, drafts a programs teaching debt management, budgeting, and productive borrowing. For instance, AKPK's Power program targets young adults cultivating better repayment habits to ensure sustainable household debt. At the same time, the monitoring of household indebtedness is critical. So lowering the OPR cheapens credit, increasing the household debt to GDP ratio, and risking defaults that threaten banking stability via rising NPLs. Consequently, BNM tracks DSRs and financial margins. So to prevent overborrowing, BNM caps loans and enforces strict assessment for borrowers exceeding a 60% DSR, identifying risky loans to keep the financial system stable and household debt manageable. So to maximize the policy's benefits, the most recommended measure will be targeted fiscal support for vulnerable households and the enforcement of responsible lending requirements. This is because it provides the most comprehensive and well-integrated solution for the weaknesses that are shown during an OPR cut. So these 2 points keep the aggregate demand up without affecting the safety of this financial system in the long term.
Should Bank Negara Malaysia maintain, increase, or reduce the OPR in 2026? From the BNM report, the title is Economy and Financial Development in Malaysia in the First Quarter of 2026. The Malaysian economy expanded by 5.4% in the first quarter of 2026, driven mainly by domestic demand. Household spending remains supported by positive labor market conditions, with the unemployment rate staying low. Alongside targeted policy measures, investment growth was underpinned by continued implementation of multi-year projects by both the private and public sector. A high realization rate of approved investment, and the ongoing rollout of the National Master Plan. On the external front, export growth remains strong, driven mainly by continued expansion in the electrical and electronic E&E export. Meanwhile, gross import growth moderate and means slower growth in the capital, intermediate, and consumer good import.
Next is to discuss whether should Bank Negara Malaysia maintain, increase, or reduce the OPR in 2026. So according to the report from BNM, Malaysia's economy grew by 5.4% in the first quarter of 2026. So this indicates strong economic growth, which is actively supported by strong household spending, low unemployment, and also strong investment activity, including the growth of export activity. So, given that economic conditions are already good, there is no urgent need to reduce interest rates. Therefore, BNM should maintain the OPR. Maintaining the OPR will help keep inflation under control while supporting sustainable growth. Furthermore, prevents households and businesses from taking on excessive debt due to lower borrowing costs.
So, does reduction of OPR really benefits everyone equally? No, it doesn't. It splits into two categories, which is winner and losers. Winners get a lower interest rate, which means it's a cheaper installment. So basically, they have more cash in hand to be used. Otherwise, for losers, like savers, retirees, fixed income earners, get lower interest rate for their money, for their cash back. So basically, they get lower money compared to when it's higher interest rate. So For reduction of PR, the positive effect, does it outweigh the risk of high inflation and higher household debts? Yes, it does. Even though there's a risk it can happen, the risk can be managed through BNM's monetary policy and also responsible borrowings. So that's all.